Hello, I'm Josh Shipman and I'm one of the co-founders and co-CEO at Elula. At Alula, we are an AI machine learning software company, and our software product is called Sticky. And Sticky helps banks retain home loan customers. Sticky will predict when a customer is going to externally refinance or property sell 3 months out before that customer will, and provide the best conversation to have in order to retain that customer. It's fantastic to be back here for a second year at the RFI Australia Mortgage Innovation Summit. Thanks to RFI for having us back, and for you guys for attending and listening again. Last year, at the beginning of 2020, I shared that retention was going to be a huge problem for the year ahead, and boy, has that been a massive problem. We're going to talk today a little bit about the market and what's happened. And primarily what I want to do is share with you a case study of a bank that stepped into this at the beginning of the year and has managed this really well. And how they got going and the types of things and results that they got from this. But before we do, I thought it would be worth sharing a little bit of background on Alula. For those of you who don't know us, I realise that quite a number of you here today are customers of Alula, and we thank you very much for that. But Alula started about 4 years ago. Both myself and Sarah, who's my co-founder and co-CEO, founded the company, and it was very much on the back of being frustrated within the banks, that's our background and career, around how long it took to get things done, and this noticing and acknowledgement that really big problems were going unsolved. And what we wanted to do was bring business-ready AI solutions to the market to help organizations get going a lot quicker, and be able to tap into these solutions and software without the need to solve and build everything themselves in-house. Was there a way that we could get going a lot quicker? So let's talk about the fact that customers are leaving, and what are we doing about it? What are different banks doing, without naming names, and kind of where are we seeing challenges, and where are we seeing those that are succeeding do well? So 2020 was record-breaking on so many levels. We saw an enormous increase in refinance numbers. So just external refinance loans in the market was up 32% on the previous year, which is huge. So that runoff problem, solving for retaining customers, is very much a big problem for organizations, and it's here to stay. 2021 is going to see these types of numbers again, is our prediction. And so retaining and saving these customers and looking after your customer base, and really future-proofing that loan book is more important than ever. What we see in the market is banks take, there's a few different approaches. There's a couple of different buckets. The first bucket is this unaware bucket. This really looks like a discharge form comes into the bank, and the bank will send a pile of discharge forms to some poor soul in the contact centre who has to make this really difficult conversation to talk that customer off the ledge in order to save them. That's in the unrecoverable bucket. I mean, you might get some results, but it's certainly not proactive, and you certainly don't know who is at risk of leaving. Some banks have taken somewhat of a rules-based or basic sort of propensity modeling strategy. And what that looks like is sort of segment targeting. It might be a rule, or the propensity model tends to lean very heavily towards a set of rules that could be, if there's a fixed rate loan expiring in the next month, 2, 3 months, then let's contact all of those customers. If it's broker originated, hey, let's contact them too. If it's whatever, the tenure is between X and Y and the loan value is this and that, let's contact those customers. The reality of that is that only about 15% of those customers that you contact were actually going to churn. So while something is well intended to save the customer, it has a really negative impact on the P&L, because what we see in the data is that it awakens these sleeping dogs. And a lot more customers actually leave and go rate hunting because they've been alerted to the fact. Some of them were perfectly happy as they were. And what's critical is contacting the right customer who is actually going to churn, because what ends up happening is you're contacting the wrong group of customers there. What we can see is, who knows what that person was actually thinking that you contacted. They just wanted some scrambled eggs, but in fact this other table of customers, there's somebody in there that actually is really in the market looking for a new lender. And it's being able to identify those early and proactively and have the right conversation. Last year, I shared a little bit about explainable AI, being able to not only predict which customer is going to leave, but unpack the black box of machine learning and be able to understand why models have made the decision that they've made and have the right conversation at a personalized level, so that we know, hey, John is planning to leave, and the reason being is there's a complete change in his home loan needs, so we need to have a conversation with him about this. And explainable AI really enables you to go beyond predictions and have that personalized conversation with context. It's transparent for the front line, it's auditable, and most importantly, you're on the front foot having the right conversation with the right person on the item that actually matters with them. So in early 2020, sorry for the sirens passing here, in early 2020, we kicked off with one of our customers. With many of you, we aggressively got on with things. I think what we saw in the banking sector was two things happen. There was a bunch of banks that said, retention's a massive problem, let's get cracking immediately. And that was senior executive sponsorship to get that done. And then there was a bunch of banks that said, hey, we're going to wait until the end of the year to try and solve that problem. This case study is one of those banks that got on with it. And this is a tier 2 bank. And roughly about a $50 billion loan book, 9.5% churn rate. Importantly, churn here, let's just sort of get on the same page with the definition of churn. This is external refinance out and property sales. So in these numbers here, we exclude natural payouts. We don't want to be predicting someone's going to naturally pay out. We want to save those customers that are leaving the organisation. There are other treatment and conversations to have with natural payouts. But focusing in on this case study, so the bank came to us and we kicked off work. And to sort of set the scene and describe the problem space that they're in, and hopefully many of you today will also relate to some of this. Look, the banking environment is large, it's complex, and it really is messy. But the problems that this bank is facing, and perhaps you relate to some of these, is that, obviously the retention number is increasing. In some places, guys, what we're seeing is still all talk and not that much doing in this space. But there is a lot of talk about it, which I suppose is a positive thing. But the challenge is about moving it into executing and actually getting on with this one. And one of the things that restrains all of this is that the bank was capacity constrained. And the capacity comes in a few different spaces. The first one is at the business level. The executive manager or the general manager who really has the commercial acumen and deep understanding of the problem doesn't have the capacity to invest in solving this problem, because there's 100 other things that you guys have got to get on with. The other capacity issue is in the data team. The data team are flooded with requests, a report for this, a report for that, a project for this and a project for that. And it's really hard to get on with so many things, let alone the roadmap of migrating X and Y around the organization. And so there's this enormous pressure around capacity. Layering in the fact that largely the technology isn't ready within the banks to do true machine learning in production. You know, there's data everywhere, and the cloud environment isn't set up. You know, the ML in production is a lot of compute required. It's computationally intensive to get these things done, and it's very hard when you're at the bank to be able to stay on top of the latest and the greatest technology, and always be on top of that. The other problem, you know, certainly with the rules and these sort of in-house, the propensity models, is that the frontline aren't empowered, and then the benefits don't get realised. And what I mean by that is the frontline, they simply do not care, nor should they care, about data science metrics. They don't need to know what the Gini coefficient is, or what the cumulative gains is, or the lift ratio. These things are not important to the front line. What they need to know is who's going to leave, why they're going to leave, what conversation do I need to have, and what are my KPIs, how many calls do I need to make per day, how am I empowered with the information I need and the insights to retain that customer. And we don't see that. We don't see that happening. That was definitely a problem at this bank. And the last bit is, and you guys can all have a think about whether or not this relates to you or not, is a little bit of procrastination. Sometimes we have a concern that, well, the data is everywhere, it's too hard to understand, or we've got a roadmap for 5 years that's penciled in for us to move in this direction, so we probably need to just wait until this thing happens. And I'm not suggesting that those things aren't important. It's really important to have that 5-year roadmap, but how do you find the balance of delivering better customer outcomes, better shareholder returns, whilst delivering that strategy at the same time? And that was really the current state of what this bank faced. And they selected Alula for these reasons. The first one is because there's this business-ready software that can get going straight away. So there's no need to build and invest billions of dollars in data science and the technology underpinning it. It's all there and ready to go. We have deep business domain knowledge in the home loan sector, and are able to bring all of that into the software product. And what that means is you realize these benefits at a rapid pace. So within a matter of 12 weeks of commencing work, you can be saving your first customer and having a really positive impact on that customer base and a P&L impact. Quite a number of you know about the Sticky product, but for those of you that don't, I'm going to share with you a quick 60-second video, and it's going to give you a bit of context around what we do and how we do it, and then we'll dive into the case study.
Understanding customers and how they really feel about us? That's been a pipe dream until now. Elula is using the power of AI to bring customer knowledge to the next level, and we believe it should be accessible to all. Welcome to Sticky. This is AI customer retention software that's business ready from day one. It works by running marathons to search out key behavior and identify which customers you should be engaging with. There's a lot of science behind all this. Let's start with our AI retention module. Here, Sticky looks beyond just one model. It divides the work across many different models, all actively competing against each other to provide the ultimate prediction. And if you dig deeper, you'll find even more models within these modules. This is customer understanding on a micro level. Sticky analyzes massive data sets of customers. Let's look at Lucia, Anav, and Tom. They're all bank customers. Sticky identifies which one of them will be out the door soon, and it could be the result of any number of things. Sticky gives us a true understanding of why. It then uses explainable AI and mathematical optimization, so you can intervene to stop customers like Tom from leaving. Sticky lets you have the right conversation with the right customer at the right time. And all this insightful data is easily accessible through our Sticky UI or as an API. This is a true end-to-end retention solution powered by serious AI muscle. And it's just one way Alula keeps your business future-proof.
Okay, so we kicked off with the bank, and the first step was for us to open up our Sticky data catalog and identify all of the data sets that were available within the bank. And as you can appreciate and imagine, typically there's about 20 to 25 disparate data sets in all different structures and formats across the organization. And one of the key value propositions that we bring here is that we will do all of that engineering, all of that data engineering, transforming the data, cleansing that and centralizing it into one location, doing all of the joins. And we do that with an amazing team and a bunch of tools that we've built that enable that to happen really quickly. So for us to take about 20 terabytes of data, of all of this unstructured data in different formats and bring it into one location, prepped and ready, was about 7 weeks to have all of that information available. And within the product, there are over 20,000 churn features. And what we need to do is ensure that all of the feature engineering elements happen. So that's identifying all of the churn elements and bringing that and matching that together with the right data. That's a 7-week period. And then we set up and train the sticky product. So obviously all of the models and everything is already built. So this is about tuning and completing all of the robustness testing and making sure that the predictions that come out are the most accurate that they can be. So there are several hundred models that sit there all competing with each other, and we want to make sure that the results we're delivering are the best that they possibly can be during that 12-week setup. Now, of course, over time, as this happens on a monthly basis of refreshing data, these models improve and quite an accelerated rate as well. Now, the key thing within that 5 weeks as well, we work really closely with you to make sure that the conversations that Sticky is generating are fine-tuned and written in a language that makes sense to your brand. So the conversation that you're having, if you're a credit union and you talk about members, or you're a bank and you talk about customers, whether you're a non-bank lender, the language you use tends to be a little bit different, and we will help you set that up so your frontline have the right conversation and are trained in how to use the user interface or a feed back into your system. But the thing that we were able to achieve here, which has been consistent with all of our customers, is from the day that we get our hands on the data to saving the first customer is just 12 weeks. So the time to value is very, very accelerated. And it means you get immediate ROI straight away, hitting the P&L, you get a positive customer impact and hopefully an improved NPS in time as well with this. Just reflecting on one of the things I said before, during the setup, one of the things that we do is we test and we have a look at what all of these rules on their own might have performed, and how they would have performed and the type of results that you might be able to get. So I talked about fixed rate expiry before, and you can see there that it's a very, very small impact relative to what machine learning can deliver when you join all of this together. It's a very small impact. There is an impact, but we talked about the sleeping dogs and all of that. Interestingly, the best performing data set, which isn't really that close, but still the best performing data set, is property listings data, which we consume from third parties and bring into the product to help with the predictions. It's a really good data set and it's super useful, but on its own, these things, fixed rate expiry, property listings, tenure, on their own, they're not enough to save customers and go really targeted. And then we go live with the Sticky product, and going live, it's not just about sending results over. As I said, it's about really that last mile and making sure that the retention team are set up to proactively engage with their customers, because that's when this value actually gets realized. That's when the rubber hits the road. The whole point in an initiative, a customer retention initiative, is to empower your front line, right? It's to get them out there, making the calls, making the conversations, and saving those customers. So we spend a good amount of time with your teams being able to set it up, and that's what we did here with the bank. Knowing which conversation to have with which customer is so important. And here's some examples of the conversations that are generated. Let's take one on the left here, Stefano. All of the names here, by the way, I've made up the names because obviously we can't use real customer names, but this should give you an idea of the type of information that gets surfaced in the user interface. So we've got a bit of context here, a bit of background on Stefano and the type of loan he has, how long they've been with the bank, and then the recommendation, why that customer is going to leave and what to talk about. Obviously the UI has a lot of information in there as well. You can customize it, add promotions as your strategy may be. But here you can see the types of conversations that are coming out of the product. And the front line love having these because what it does is it takes them away from that really awful discharge form conversation and moves the team into a really positive space. They're very excited, they like using the sticky product, they're having really good conversations, contacting customers they've never been contacting before in a really proactive way. And some of the success stories that we've loved coming out of this have been not only some of these customers are so happy that their bank has proactively contacted them and worked with them, that we've seen referrals from those customers for new loans coming through as well. And what a different place to be, having your existing customer base refer other customers in. So in terms of the results, you know, we didn't get to complete a full year with them because, you know, we started part of the way through 2020, but approaching the full year now, we're seeing, and I've annualized this, 3,500 accounts per annum saved, and they're on track to approach short of $1 billion of loans per annum. I think that their next year in this is going to be even higher in terms of benefits, but let's assume that it just stays at this type of ratio. The revenue uplift, as you can see, is quite significant over the 3 years. So there's a lot of value to be gained in really focusing in and getting this retention one right, moving it from conversations about retention and actually solving the problem. 2021 is going to be a tough year when it comes to runoff. It's not going to just cease straight away, so it's so important to be on the front foot with that. And this bank in particular is set up in a really good way to solve that. We want to help, and we today, as part of a long-term partnership that we have with RFI, are happy to put out a special offer to anyone today who wants to get going before 30th of June. We're prepared to throw in a $200,000 credit that you can use with Alula. All you've got to do, just email me and we'll have a conversation. Just mention the RFI conference today, and we'll bring that through for you. It's been a real pleasure talking to you today, and we look forward to working with you in 2021. Hopefully you get to meet some more of the team. We've got a fantastic bunch of engineers, software engineers, data scientists, banking executives as part of the team, and we look forward to meeting with you and working with you. Thanks to RFI for having us here once again, and I look forward to speaking to you all soon. Thank you very much.